Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. President Biden said that climate change is one of the biggest threats to the world today. SEC Chief Gary Gensler seems to agree with him. On Tuesday, the House Financial Services Committee will hold a hearing to examine the SEC's priorities for 2023 and the SEC's ESG, environmental, social, and governance agenda, including Gensler's controversial proposals to require corporate disclosure on climate change and board diversity. It's likely to get significant pushback from Republicans. Let's talk to two ETF experts closely involved with the ESG issue. Dave Noddick, financial futurist at VettaFi. Arnie Nowak, head of systemic investment solutions for the Americas for DWS. That's a major ESG provider. Dave, the Republicans are going to make a claim that Gensler lacks the authority to impose climate disclosure regulations on corporations. How much will corporate America push back, and what's the likelihood we'll see Gensler's proposals will even see the light of day? Well, just on climate now. There's 40 of them out there, folks. Okay, we lose track of them, but just on climate.
On the climate disclosure one, there's going to be enormous pushback. There already has been, largely because this is a pretty big administrative burden. The way this is written, whether you're a fan of ESG and disclosure or not, the way this disclosure would have to be done would be pretty burdensome. And so I think they're going to get a lot of pushback. I think the chances they actually get something like this through this year, probably pretty low. I think we're in a little bit of a cooling off period. I think we'll see some of that challenge happen on the floor tomorrow as we hear about it. But it's an important topic. But it's one also I think that we should point out the institutional community is already all over.
Yeah. You know, speaking of the institutional community, Arnie, they are already positioning their portfolio on climate change, particularly over in Europe. It's a normal part of the conversation here. It's politically sensitive here in the United States. Now, you floated a new climate action ETF last week, DWS did, that already has $2 billion in assets. Explain how you got $2 billion in a week in an ESG ETF.
Yeah, with great pleasure. It doesn't unfortunately happen every day, and we'll work on that for next time. But USCA is the ticker symbol of the ETF that you referred to, Bob, which essentially looks at the top 50% of companies within each sector. So it is a sector neutral or close to sector neutral type of approach, and still looking at which companies within which sector, within the different sectors, are best suited from a climate angle. And how this has come about is, frankly, Ilmarinen, who is the big investor in USCA, were previously invested in USSG, which is a more broadly focused ESG type of fund, tracking the ESG Leaders Index of MSCI. And they decided simply to hone their overall investment strategy and shift from a broad ESG focus to a specific climate focus.
This is Finland's pension fund, essentially.
Yes, it's a pension insurance company for Finnish, essentially private
sector. They were already in one of your ESG funds, and that was a broad ESG fund, and here they're just switched over to focus specifically on climate. Is that a noticeable trend in Europe right now?
I would say
focus on climate over everything?
I would say yes. So it starts out with broad ESG topics, looking at, you know, environmental, social, and governance-related aspects. And then the next steps for a lot of institutional investors, not only in Europe, but I would argue also here in the US, in particular on the coast, thinking about, you know, New York. And, you know, we recently saw that. I think last week there was an article around the New York employee retirement system, making certain declarations from a net zero standpoint, but also Californian institutional clients are looking to hone in specifically on climate as a relevant topic.
I'm surprised how controversial this climate thing is, given how many companies, if you're a U.S. company in Europe, you already have to make disclosures, right? The only thing, I mean, I disagree with Gensler on a lot of things, but he's sort of making a point. Folks, everybody's doing this. Let's standardize the process. At least that's an argument that makes some sense.
Yeah, absolutely. And, you know, when we're talking about the different ways you can do this kind of disclosure, you know, the indexers like MSCI and folks, they're already capturing a lot of this data. So it's not like this data doesn't exist. And if you look at the S&P 500 companies, all of them are already disclosing this kind of data. I think the overreach here is what's called the scope 3, right, where you're starting to look at the impact of your company, not just in terms of your products and services, but what your supply lines look like and what your customers do with your product. That can be a really challenging thing to document in a really standardized way, and that's where they're going to get the pushback.
Well, now you're making me work, because now we're going to have to explain scope 3. We can't assume the viewers understand it. He always does this to me. He makes me work. So, folks, those of you who aren't sure what he's talking about, a lot of the debate revolves around disclosure of greenhouse gas emissions. So there's 3 categories of greenhouse gas emissions. Here they are. Aren't you glad we do the work for you? Direct greenhouse gas emissions are controlled by the company. That's scope 1. Scope 2 is indirect greenhouse gas emissions associated with the purchase of things like electricity or steam or heat or cooling. And then there's scope 3, which is what Dave's referring to, which is indirect greenhouse gas emissions that are produced by customers using the company's products. So 3 different levels. So dividing these emissions into 3 groups is the purpose here is to help measure progress in making reductions to limit global temperature rises. So remember, under the Paris Agreement, it was supposed to be 2 degrees or below. That's the game here. So much of the pushback, Dave, now that we've educated you all, is around these scope 3 emissions produced by customers using the company's products. So and that seems a bridge too far for a lot of people.
Well, I mean, imagine that you're, I don't know, AMC movie theaters, right? How do you judge the emissions of your customers showing up at your movie theater and consuming the popcorn? That's a bit of a ridiculous example. But when you think about both the supply line, which is also part of scope 3, and then the usage line out of it, it becomes quite large. And different people disagree on the best way to measure and manage that. And most companies are doing something appropriate to their industry. Otherwise, they get ignored by the ESG funds, and nobody wants to do that because you got $2 billion showing up at Arnie funds.
They have a good point about pushing back. It's one thing, like, I'm Exxon. I might have direct greenhouse gas emissions that I can measure, but emissions produced by customers, that seems like, how would we even get that? Understand that? What's the measurement process? It seems like a bridge too far for a lot of people.
Yeah, I would say with anything, you know, regulation straddles the line of having to be precise and specific and also practical. You know, and something like this, I would argue that, you know, measuring scope 1, 2, and 3 emissions to some degree is already a market standard. They've already alluded to that. The likes of S&P, MSCI, all major index providers in their Paris-aligned benchmark indices. For the viewers who are not aware of what a Paris-aligned benchmark index is, it's essentially an EU regulation with an index construct that is designed to create a pathway towards a net zero environment. And in order for those to function well, certain assumptions have to be made in order to measure scope 1, 2, and 3. And, you know, where regulation becomes useful is to level set that, to make sure that all disclosures as harmonized as much as possible meet that great objective to meet reality. Obviously, there will be some friction.
Yeah. Now, we had this morning, we had Suzanne Clark on. She's the CEO of the U.S. Chamber of Commerce. She's on fairly regularly. Speaking very generally, she decried the huge number of proposals that Gensler is floating and had this to say about all these proposals. Take a look at this.
We do everything we can to work with Chair Gensler and his team. We submit comments, we have meetings, we do everything that we can to try to get the appropriate amount of regulation and smart regulation accomplished. And if that doesn't work, then we take them to court.
Take them to court.
Take them to court.
We're going to sue them. We're going to sue them. Now, I want to make it clear. She was talking about all of these proposals generically, but basically they're signaling this is way too much stuff to dump on us. And we think in some cases you're exceeding your authority. We think in some cases they're overreaching, et cetera.
Yeah, I don't. The lack of authority, the lack of jurisdiction, that's actually a bit tough to argue. The SEC has pretty broad mandate about what companies who trade on public exchanges have to disclose. So I think that's not where you win this argument. It doesn't surprise me people are already talking about suing on this. I think there is an administrative burden here. I think it's unfortunately going to be political, and that really shouldn't be what this is about. It should be, as Arna was pointing out, about having good regulation versus just regulation for regulation's sake.
Yeah, so you don't think they'll succeed? I mean, again, we're talking broadly here. There's many proposals. You don't think that suing them on the grounds that they're outside of their authority will work? You know, there was that EPA, that court ruling on the EPA saying they were overreaching. Government regulators were doing too many proposals outside the original scope.
Yeah,
so that's going to be brought up tomorrow.
Suing regulators, and I'm sure that we're going to see more of that. The SEC is already being sued by Grayscale around crypto, XRP around Ripple. And we've got plenty of lawsuits going on, and the SEC is not looking like they're going to win very many of these. So I wouldn't be surprised to see Gensler and the SEC backing up a little bit here, and maybe being a little bit more thoughtful in this process. Well,
how do they back up? Again, we're just sticking to the climate proposal for a minute. Would they back off on scope 3 and say, can you divorce that? If they took that out, they would have to resubmit the proposal, wouldn't they?
I suspect we'll see a resubmitted proposal. I think that's exactly what we'll see.
That will only do scope 1 and 2, and
or that we'll have
3.
a phase-in, or we'll have a learning period. I mean, remember, regulation doesn't always have to be about must do this. Regulation can be about, hey, we're asking for voluntary compliance for a period of time to get information. We've seen that in market structure all the time.
Yeah. And again, we're showing you scope 1, 2, and 3. Remember, these are different levels of reducing greenhouse gas emissions. All this goes back to the Paris Accords, and all 3 of these are required under the Gensler proposal. And the question is, are they going to back off on this? I want to go back to the old ESG like we used to talk about 3 or 4 years ago. And why is tech showing up in all these ESG? So I looked at your new USCA, your climate action ETF. See if you can bring this up, the biggest holdings. So I see the largest holdings in the ETF. It's still big cap tech stocks: Microsoft, Apple, Amazon, Nvidia, Alphabet, Facebook, Tesla. They're all 6-5. Here you go. Can you explain your methodology, Arnie? Why we had this problem 4 or 5 years ago? Why is big tech showing up in the climate action? How do you explain that?
Yeah, so it's often a little bit of a misperception what are climate-focused investment, what are ESG-focused investment. Sometimes I feel like, different people look at it through the lens of what they want to see, as opposed to what the reality is. And the reality is that the broad field of ESG does encompass a lot of different versions and methodologies, similar with regards to climate-focused investing. And what we're looking at here is still a strategy that is somewhat tied to the original benchmark index, which is the MSCI USA. So what's relevant is the starting point of the overall market. Right. So all the big stocks of, Microsoft, Nvidia, et cetera, they are by definition always relevant for something like this.
But assume I'm an idiot. Don't laugh. Well, you're laughing. I knew he was going to laugh. The minute I said that,
we've always
assumed that, Bob. No, look, and explain why Microsoft, for example, is your biggest holding. A normal person would say, "Oh, climate action." I don't think Microsoft. But explain why Microsoft.
Okay, perfect. So what it looks at is, it looks at what are the different climate stocks, or the stocks that do best for the climate of each sector. And what features into this are the emissions, scope 1, 2, and 3. So how much does a company emit? How much do their suppliers emit, et cetera, et cetera. But then also how much is that company planning and publicly issuing and declaring and making public their plans to reduce the emissions, and how credible are their plans? Do they have so-called science-backed targets? And then lastly, for companies like Chevron, for example, how much do they actually engage in so-called green business? How much money do they invest in the development of, fossil fuel energies and other sort of sustainability-oriented businesses?
And how do you account for the fact, people used to ask me, well, Microsoft has far fewer greenhouse gas emissions than Exxon would. They're in a different kind of business. How do you account for those differences?
Yes, so the measurement is not cross-sectoral, it's a ranking within each sector. So Microsoft is compared with the other tech companies. Chevron is compared to the other energy companies. It's a like-for-like comparison, and then we select only, or the index rather, selects only the companies within each sector that do the best, and the worst within each sector are excluded.
So your point is there are energy stocks in this?
Yes.
Right.
Is the weighting of energy is what, 5% in the S&P? Is it weighted by energy?
Roughly the same. But it's interesting because you mentioned tech stocks in the beginning. The tech sector is actually slightly underweight in USCA compared to the benchmark.
Yeah, okay. Now, just moving on for climate, staying on ESG, though, Gensler is also floating a proposal on board diversity, asking people, requiring corporations essentially to file reports on the diversity of their boards. This is going to be voted on later this year. This is getting all caught up in the ESG
this seems much less controversial.
Yeah, I want to meet the people who say, I don't want to know no women on boards. Right. I want to meet the people
I think the most important topic in
What's the problem with this?
So the problem is that people don't like the idea that shareholders are paying attention. That's honestly the answer. A lot of the proposals we've seen are about giving shareholders more voice in the proxy process, and understanding who's on the board and making proposals to put different people on the boards. I'm generally a pretty big fan of those things. Who runs companies has become one of the most important topics of our lifetime. We now know the names of CEOs, Elon Musk, that we didn't used to know on a day-to-day basis because they're public figures. They are impacting our lives.
Are people resenting the idea that we're requiring the disclosure of it, or are they actually resenting the diversity concept? That's, I think, the problem that I'm having. Why? Well, you shouldn't mandate more information on what your procedure is?
I believe personally that people should always have access to information, right? So that's why the ESG stuff starts to get squirrely around that scope 3, because in general, more disclosure is better. It lets people make their own decisions. It lets people build indexes and products around those things. If you don't want to invest based on board diversity, there are plenty of ways to invest not based on board diversity.
All right, I want to move on here. We can get dragged into this all afternoon. Another big issue out there is going to be crypto. And their problem here, there's still no clear understanding of whether crypto tokens are securities or whether they're currencies. And still no Bitcoin ETF. Grayscale, of course, is suing them. Our friends over there. Handicap this. Talk about the Grayscale suit.
So
they're suing them, arguing you can't have a futures product and not have a spot product. It's illogical, makes no sense. What are the chances Grayscale could win?
I think the chances are more than 50-50 that they could win this lawsuit. However, I don't think that means that all of a sudden we get a Bitcoin ETF. I think there's actually a higher likelihood it means that they shut down some of the futures-based products. Not a particularly popular opinion, but there's no way to force a regulator to approve a product. That you can't actually mandate a regulator to take an action. You can slap their hand about having failed to take certain actions or having taken actions you disagree with, but the way they fix that problem is still up to the SEC. I suspect that even if Grayscale wins, Gensler is going to back even further away from crypto and not necessarily approve a spot Bitcoin ETF, but put some constraints around the futures-based products while we wait for maybe someday comprehensive crypto regulation and legislation in this country.
Right. In the meantime, the critics argue that Gensler is doing regulation by enforcement.
Which he absolutely
He's actually suing the daylights out of the crypto business.
And very, very capriciously, right? He is suing certain companies for certain acts, claiming that they were doing things with securities, but leaving aside whole other parts of different ecosystems, right? We're not trying to regulate swords in World of Warcraft, but you could argue they fail all the same tests he's arguing for.
Are tokens securities or commodities?
Well, the point is nobody knows, and somebody has to create a comprehensive rule.
If you're getting
the Howey test is
why not?
Because it's not designed for this ecosystem. I'm with Hester Peirce on this at the SEC. She sort of has this framework with what we should be focused on is capital raising. That's what the SEC should be worried about. If you're raising capital by issuing tokens to then go effect a purpose,
that's a security.
That's a security. We can talk about that. That's not really what the Howey rule is, and that's not really what most of these enforcement actions are about.
A lot of this would be securities then.
It would be, but the point is we need legislation. This isn't going to get solved by the stroke of a pen at the SEC's desk. We need Congress to work. They already are on stable coins. I think that's where we're going to start breaking this dam open. Hopefully this year we'll actually get some action on that.
They're starting stablecoin. What's the distinction here that you want to make?
So stablecoins are basically money market funds that you use for payment on crypto rails. They're like USDC is a big common one. Some of them recently broke the peg, as it were, when we had a little mini banking crisis you might have remembered from a few weeks ago. A good set of legislation is on the table to basically bring them under the umbrella, actually have them being regulated by the Fed, because effectively they're going to be money market instruments. I'm a fan of that. I'm hoping we see some action and actually get some votes on it.
And what about the whole jurisdictional dispute between the SEC and the CFTC? This is historic. It goes back, since the dawn of the commodities markets. These are CFTC primarily grew out of agricultural regulation.
Yeah. Look, the whole, is it a commodity or security thing? I think having two regulators argue about it is the wrong way to solve this problem. I think we have to have legislation that realizes digital assets are different and they need different sets of rules.
And what's the chances that we're going to actually get legislation?
Well, I think we'll get stablecoin at least a shot at it this year. That might break it open to be a post-campaign issue, so 2025, maybe.
Good handicapping right there. I don't know. Given the dysfunction in Congress, they can't even lift the debt ceiling for crying out loud. We had Speaker McCarthy here today berating the Biden administration for failing to negotiate on the debt ceiling. That seems like something that's not that hard to negotiate. Okay, folks, you heard a lot of topics here, but we're trying to go through a lot right now. Gensler's going to be testifying tomorrow. We'll have coverage of that as well on CNBC, and I'll have a Trader Talk out tomorrow morning on CNBC.com. That does it for this week's ETF Edge. My thanks to Dave and Arnie, and we've asked Dave to stick around and give us his perspective on hot trends in ETFs, other hot topics for the rest of the year. Remember, you can see all of our shows, the whole history, all 5 years, ETF Edge at CNBC.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.